Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood with Union Financial Services. And today I'm joined with a really special guest, Jason Johnson, who is a mortgage broker with Sunpoint Home Loans. And today we're going to be discussing why the wealthy love debt and why you should too. So welcome, Jason.
Thank you. Thank you for having me.
Yeah. So tell me a little bit about how you got started in the industry and a little bit of your history on being a mortgage broker.
That's a great question. So started in 2003. I was actually a remodeling contractor and doing a lot of estimating for a high-end remodeling company in Minnesota. And my wife was a mortgage loan officer at the time. And I started talking to her boss and started talking about the refinance market that was coming up and found an opportunity to join a company called Wells Fargo. And I worked for them for 9 years, and I learned how to do refinances first and foremost, and then got into the purchase market. But my math background got me into mortgages at that time. So it was kind of just an easy transition going from estimating, running numbers for people to running different type of numbers for people based on refinancing.
So you got into the industry before the 2008 bubble and have sustained it all the way through. So how many years do you have now?
22 years experience.
Wow. Amazing.
Yeah.
And it does show. I will say to all of our listeners, I have personally used Jason Johnson for a mortgage, and the process was as seamless as it could have been, even though it's a stressful process. It's a stressful transaction, but I do recommend you to everyone I know. And you really are going to be sharing a lot of education today with any of our listeners that are either thinking about using some equity from their homes, or maybe they're getting a first-time mortgage or need some reconsolidation of some existing debt. I think you're going to share a lot of education on that because it's really at the forefront of a lot of Americans' minds, buying real estate, investing in real estate. It's a big process.
It really is. So I would love to answer any questions you have today and help educate your audience on refinancing, purchasing, et cetera.
Okay, awesome. So before we really dive into some interesting questions, I want to use an example to show everyone the power of leverage. And leverage is using the bank's money to ultimately build your own wealth. And I want to go through an example of why celebrities take out mortgages when we know they have the funds, they have the liquid assets to just buy things in cash. So why in the world would someone like Meghan Markle and Prince Harry take out a mortgage?
It's pretty simple, honestly, and I see this every day. So when you can borrow and leverage the bank's money, you're not borrowing your own money. And when you do have a good financial advisor, you can remain liquid to where you're leveraging the bank's money, talking to someone like yourself and finding investment opportunities and staying liquid immediately. So if an investment opportunity comes available, you have the cash to do it versus trying to wait for a bank to borrow the money back out of the property.
And so a real world example with Meghan Markle and Prince Harry, they bought a $14 million home. And now obviously we're using big numbers here. It's still a good example, but scale it back on your own numbers, on the middle class numbers. But they bought a $14 million home and they took out a $9 million mortgage on that home. Could they have bought it in cash? Most likely, I would say. So why would they take out that $9 million mortgage, paying an interest rate of about 6% on that mortgage? Seems crazy when you first think about it, but let's say if they invested that $9 million that they borrowed from the bank. Now their loan rate is 6%. They invested that $9 million, and even if they earned just 8% interest, so just a little bit more than what they're paying, if they earn that 8% on average for 30 years, you want to know how much money that $9 million would grow to?
It's a lot.
$83 million. It's staggering. And how much would they have paid in interest over those 30 years? I'll tell you, it's $10 million. So they have net profited $73 million by taking out that mortgage and investing the loan.
Correct.
That's why celebrities love debt. So that's our hook. And that's why you should love debt too if you're listening to this. Use debt to build your wealth. If you do it the right way with a good loan officer and with a good financial advisor, you can really build up your net worth and always have that liquid money. So that's kind of just an example of why celebrities do take out mortgages. And it makes sense when you think about it. So tell me a little bit more about some of the process of how someone, let's say they're buying a first-time house. How do they get pre-approved? What is the first step in that whole process?
The first step is obviously talking to a mortgage broker or a mortgage advisor or loan officer, because we're going to guide them through the process. And we're going to look at everything from their bank statements, their deposits, to their monthly income, to their credit, and establish what products and programs are going to be best for them. So a lot of times people get very emotional when it comes to buying real estate, and they see a property, it's shiny, it's new, they fall in love with it. They have no idea how much they have to put down, how much closing costs are going to be, how much the monthly payment's going to be, and they're wanting to write an offer on it. So when you get pre-approved, you get a base of where you should be looking, what you should be looking at based on your current financial situation.
Okay, so that really is step one. Before you even think about buying a house, you have to get pre-approved
Correct.
first.
Yep.
Okay.
And it lets everybody know in the process that you're serious about this. So if you go to look at a home, the selling agent knows, all right, they've taken some time, they've taken the steps, they've provided all their documents. They're good to go if they're serious about this property. If someone's going to show their house, you would want to know that the people have taken the time to make sure they can finance or pay cash for the property.
Okay. And how do you know how much house you can afford? Is that something that there's a formula for, or that you create a formula for?
Yeah, that's a good question. There's several formulas. So depending on what we're looking at, if they're W-2s, if they're, look at the pay stubs, look at the income, whether they're seasonal employment, whether, they're full-time, whether they have bonus, commissions, self-employed. We have several factors we have to look at for that. But that's exactly what a mortgage broker will do, is they will look at the documentation and say, okay, Mr. and Mrs. Johnson, you're qualified for up to $400,000 and a payment of $3,000 a month. If it's above that, please contact me. We'll see what we have to do to make it work for you. So it gives them a ballpark.
Yeah, because I think most people don't even know where to start on how much house you can afford or how much you should put down versus maybe not putting as much down. And it can be stressful, I will say, if you don't know where to begin. So the first step really is speaking to someone like you.
Correct.
Okay. Now, let's say someone's pre-approved. What's the typical process of getting the actual mortgage?
So once you get pre-approved and you've provided all the correct documentation, at that point it's finding the house. So if you found a house in 2 or 3 days, depending on the seller's needs, you could close in as little as 10 to 14 days. The average turn time is about 30 days. So depending on everybody else's needs, because it's not just the buyer's needs for moving out of their apartment or the house they're renting. It's also the sellers have needs. So they may be building, they may be moving out of the state, moving out of the country. You just don't know. So that's where the realtors kind of come in and negotiate that. But the average turn time is about 30 days.
Okay. All right. Now, here's a question that I've heard from a lot of people, and I think it's common to not know exactly what it is, but to think you should know what it is. So we all just pretend we do. And that is, what is a HELOC?
A HELOC? A HELOC is a home equity line of credit, and there's several products out there regarding a HELOC. So a true HELOC is basically, it's a line of credit on your house. So if you've built equity up and you say, okay, I want to borrow $100,000 of that equity to remodel my house, pay for student debt, student loan, buy another investment property or buy a vacation property, you can pull that equity from your house in a home equity line of credit. Typically, they're interest only with a 3, 5, or a 10-year draw period, and they turn into a 20 or a 25-year loan at that point once the draw is up. So you have a short period of time to borrow the money, pay the money like a credit card on your house. But then once that period's up, you have to pay it back. Now, there are a lot of products out there that are hybrid, meaning you could have a 30-year fixed rate right from the get-go, but you can still draw on it for 5 years. That's a hybrid HELOC. And then there's second mortgages, which are just a second fixed 15, 20, 25, or 30-year loan on top of your first mortgage that sets in second lien position behind it.
What would you typically recommend someone do, a HELOC or a second mortgage?
Depends on their situation. Okay. So a lot of the times the conversation comes up, I want to borrow some money. Tell me a little bit about what you want to borrow the money for. Well, I want to consolidate some debts. Well, that's where maybe we look at the fixed rate loan so it's more safe for them. I need it for a couple of years, then I'm going to sell this house. That's where you do a home equity line of credit. It's interest only. You make a smaller payment until you pay off the loan.
So what does that look like when someone takes out a HELOC? They're just paying the interest for a certain amount of years?
Correct. If you're doing the interest-only option, you just pay
Okay.
the interest, and typically they are a variable rate. So in this market, they're not that bad. People get scared with variable rate. Rates have been very high lately, and they're trending down. So if you took out a HELOC today at 6.5%, 7.5%, depending on your credit score, it could be 4.5% or 5.5% in a year or two, depending on what the Fed does with prime rate.
Interesting. So that kind of leads us into our next topic of refinancing. And I know that's been on everyone's minds these days because rates have been relatively high. Now, do I think they're high in general? No, because if you look at the last 30, 40 years of rates, I don't think 6 to 7% is that high. But yeah, when we're comparing it to the 2 and 3s that we saw, yeah, it's high. But that seemed out of the ordinary. Now, when would it make sense for someone to refinance their mortgage?
A lot of that depends on the loan size. So, if it's a $400,000 loan, you're at 7.5%, rates drop to 6.25%. The math doesn't lie. You can look at the numbers and say this makes sense. Refinancing always has been and always will be a long-term investment because you're going to reset your amortization, or depending on if you put it down to a 20 or 25 or a custom loan term, it's resetting it. So whenever you look at that, you have to do the math and see what's best for each loan. I say this every day, and I get sick of saying it sometimes, but loans are like fingerprints. I've done this 22 years. I've never seen two exactly alike.
Wow.
So it comes down more to the advice side of it. But when you're dropping $200, $300, $400 a month, if you plan on staying on that house more than 5 to 7 years, then yes, the refinance makes sense
Okay.
for a rate term.
It has to be that you're planning on staying there.
Correct.
Oh, okay.
So I've had people call me and say, I'd like to refinance. We're going to sell this house. Okay, so what are you wanting to do with the money? Well, we want to cash out and we want to probably make some repairs before we move out. So that's where we do the analysis and look and say, well, maybe a HELOC's best for you. So you're not resetting, paying all the fees for it. So there's different things you can look at in that scenario.
So let's say if rates go down 1% from now until next year, at what point does it make sense for someone to contact a mortgage broker to say, should I refinance? Does it have to be that 1%, or what's some triggers that would cause them?
1%'s always been a good rule of thumb,
Okay.
depending on the loan size again. But if you're going to save money long term and you have no plans on leaving that house, absolutely call a mortgage broker and find out if it makes sense for you. We can run numbers, we can run your amortization, we can look at everything long term and see what it's going to actually save you in interest.
What are some of the reasons that people refinance their home?
Home improvement, retirement planning. I had one the other day. They're wanting to retire in 8 to 9 years. So we were looking at several options, a recast versus refinance, looking at going to a 15-year, possibly a 10-year. So that's where I go and do the math for them and find out what's going to make the most sense for when you guys retire and want to have a nest egg and start taking advantage of that. So that's where we run the numbers for them and see what makes the most sense.
I think the important thing too, of course, it's great to get your payment down when you can refinance. The important thing too is to make that money work for you when you do refinance. If you're saving a couple $100 a month, let's not spend that. Let's at least invest a portion of that.
That's exactly
or else,
right.
what was the point of the whole refinancing? You're just extending now your mortgage. If you don't put that money to work for you, you're not really going to benefit too much.
And that's part of the conversation that I typically have with a client. So in this last example I was sharing, they're going to be saving between $700 and $800 per month. So instead of putting that towards the principal balance, my advice is, or ask them was, have you talked to your financial advisor, or do you have a financial advisor to bounce this off of to see what makes more sense? Taking that $700, $800 and paying it into something that's going to earn them some interest and then possibly be tax-free by the time they retire, or paying it towards your mortgage note. And that's where you can have a strategy with a financial advisor and a mortgage advisor and see what's going to make the most sense for 8, 9, 10, 15 years down the road.
And it's also it's an interest rate conversation. If we think we can average more in the market or in your investment than your current interest rate is.
Correct.
So when people have credit cards that have a 25% interest rate, my advice is always pay down that credit card before we invest, because on average, we're not going to earn 25% time after time in the stock market. It's going to happen sometimes, but you're probably better off paying down that really high interest-bearing debt than investing. But with mortgages and car loans, usually makes sense to invest that difference. And so talk to me a little bit more about what an amortization schedule is. Let's say someone has a mortgage, they've been in their home for a couple years now, and in a perfect world, they would like to pay off that mortgage earlier than 30 years. What's the efficient way to do that?
So when you look at amortization, it's front loaded. The banks get their money first. So the sooner you take out a loan, the very first couple of years is going to be mostly interest. And as you get into the mortgage, it's going to chip away and you start paying more and more principal balance down. So when you get into year 2 or 3 and you say, okay, I want to pay this off by year 20, that's where you can run an amortization calculator and say, okay, if I put $300 or $400 a month, for example, I could possibly pay it off. A lot of times people will talk about biweekly payments. That's one extra payment per year. Sometimes people will pay the difference throughout the month. So if your payment's $1,800, they may pay $2,000 and just round it up to help pay that off a little bit sooner.
Do you have to specify that your extra payment is going just towards principal?
Typically not. Most conventional government loans, Freddie, Fannie, if you pay extra, it will automatically go to the balance. The only reason it would not do that is if you specify, I need to pay extra on my escrow.
Okay, for taxes and homeowners insurance. Okay, got it. Now, can anyone just Google an amortization schedule, or how can they find out what their breakdown of?
You can actually. And when you
Your payment
purchase a
would be.
home, your mortgage is going to come with a pretty scary document called your amortization schedule. It's
Okay.
about 4 or 5 pages. I'm sure you saw it. And it breaks down every single payment if you pay your payment on time, how much interest, how much principal you're going to pay throughout the entire 30 years, 20 years, 15 years, whatever term you take the mortgage out on. So you're going to have a copy of that to see where you're starting at. Where the math gets sideways is when you start making extra payments and you start chipping away at that principal balance and the banks start paying less interest. Anybody can Google it. You can find an amortization calculator. You can even play with it and put extra numbers in there and say, okay, I want to pay $500 extra per month.
Yeah.
And it will show you your estimated range of when you could pay off your mortgage note.
That's very interesting because I know it can be discouraging in the very beginning getting that mortgage statement and you see, okay, my mortgage payment is $3,000 a month and $2,000 of it is going towards interest. What are you talking about? Why is it not paying down the principal? And then as time goes on, I think of it like a inverse chart. It switches.
It does.
Towards the end, all of it almost is going towards
Correct.
principal. But I think most people don't want to get to that point where they're 20, 25 years into their mortgage. They want it to be over before that.
Right.
And so another one of my questions is, let's say someone comes into a lump sum of money, whether it be an inheritance or they sell another property or a lawsuit, and they want to put that chunk towards their mortgage. What does that look like? Does that take years off of it, or does it bring down the overall balance?
There's a couple ways you can do it after talking to your financial advisor to see what makes the most sense,
Yeah,
of course.
yeah.
You can recast your loan, and that's kind of an industry secret. A lot of people don't like to talk about it because some people will say, let's just refinance you and get the commission. A recast is resetting of your amortization. So if you're taking $200,000 and putting it down on the balance, let's just use $400 for an example. Your current balance is $400,000 and you put $200,000 down towards it, you're now going to have a $200,000 payment on a recast. So it's going to reset that amortization to the new balance. So if you're in the second year of your mortgage, your next 28 years are based on paying it off in 28 years at the new recast balance, same interest rate, and it's typically only a couple $100.
Wow.
So, and that's on conventional loans only. So if I'll give you a prime example of a recast. Someone has a property in Oregon and has $400,000 equity. They pull 20% out to buy a property here in Florida with their job transfer. They put 20% down. A couple months later, that house out in Oregon sells, and they now have another $200,000. If they took a government loan, whether it's FHA or VA, they can't do that. But on a conventional, they could turn around and just recast that balance and now have the lower payment. So that's a strategy some people will take advantage of.
When is your window to recast?
Anytime. So if you take out a mortgage, now they may say 6 months because you're not in servicing yet and they've got to get it set up. I've been told 3 to 6 months. So they don't want to do a recast in the first couple months. Right.
Yeah.
But I think after 6 months, your window for that does open up. And every bank, every lender is different. They may have a guideline that says 6 months, 12 months, but it's an option for them.
And does that expire at any point?
It does not.
Okay.
Typically, it's got to be more than 5% of the balance. So you can't just say, here's $5,000 on my $400,000 balance, recast it. You got to put down a big chunk.
Okay. Okay, that's very interesting. And is that only a one-time thing?
Some lenders it is actually. And some lenders you can do it as many times possible, maybe once per year. I think they have guidelines on it. And again, every bank, they have their own overlays on it. They don't want people recasting all the time. But yeah, it is something you can typically do once per year.
Okay, so recasting. And that's great too because that will lower your payment and then If you can afford to put more on it, then you can, of course, pay off the loan
Accelerate
quicker,
it.
or you can invest it.
Talk to a financial
Yeah.
advisor and see what's best for your long-term goals.
Yeah, we can see that we're hitting on that. It all comes back to the same
Getting
the
advice.
same statement, exactly, getting advice. But that's really great, and I've never heard of that term used by anyone but you. And so recasting, it's really a clever strategy that I think most people don't even know that exists. Now, another question I have for you is the importance of having life insurance when you have a mortgage. Can you explain to me really that conversation that you have with clients and why?
It's a great question because I can't give financial advice. I don't have a license for that. However, I'm advising people on $300,000, $400,000, $500,000 mortgages, and maybe the wife is the only one who works and the husband stays home, or vice versa. If something was to happen to that person, how is that household going to be cared for? You're taking out a $300,000, $400,000, or $500,000 mortgage. That's where my advice: come talk to a financial advisor and see what it would cost to protect your family. Because if you're buying this house for your family, you're buying it for your legacy, for your wife and your children, you want to be protected. So for a couple $100 a month and you're taking out a mortgage, it's not that much when you think about it in the grand scheme of things to talk about life insurance.
Yeah, I mean, we always recommend that both working spouses have at least a couple years of income. And then even if they don't work, to have the outstanding mortgage balance as life insurance. So, even if someone's a stay-at-home mom that's technically not bringing home a paycheck, but you guys have a $300,000 mortgage, she should still have $300,000 of coverage because, first of all, her life does have a financial value. Whether it's paycheck or not, she's doing things around the house, maybe taking care of children, cooking, cleaning. Same goes to if it was the husband that stayed home. And so we want to be able to give them that financial peace of mind during a time of grief that you can stay in the family's home. The kids don't have to change schools. We can pay off that mortgage, and it's one less thing you have to worry about for a couple $100 a year. I mean, when I talk about how cheap term life insurance is, it's a no-brainer.
It really is.
If your health can allow you to get approved.
Yep.
Not always. But it really is a no-brainer. And I think it's great that that's a conversation that you have with your clients. Now, another question that I like to ask any of our guests on the podcast is the best and the worst financial decisions that you've ever made in your life so far, or one of the best and one of the worst that you wouldn't mind sharing with our listeners.
I'll share a couple. So my best advice was buying my first house, because I bought a house that was the same as my rent. My wife and I saved all summer long for the down payment. It was FHA. Remember, it was 8.75%. Everybody talks about high interest rates being 6%.
Yeah.
And we lived in that house for 2.5 years. We got married during that time period, got married in that house, had 2 children in that house. I renovated the house. I was a carpenter at the time. And we sold it. We walked away with $68,000 2.5 years later.
Wow.
Imagine being a 25-year-old parent and having that type of capital, moving to my next house, and not worrying about car seats, car payments, because I was able to leverage that money that I would have never had that opportunity renting. That's probably my best.
Yeah, I would say that is a good one. It's a little bit of luck with timing.
It was.
But it's also making the decision.
Making the decision, putting in the work, putting in the sweat equity, which a lot of people have the opportunity to do, especially here in Florida. With the housing market the way it is, there's a lot of houses that need some elbow grease. They need some work. And if you buy in it, live in it, paint it, fix it up, redo the flooring, and do the work yourself, or hire a contractor or handyman, you can reap the rewards of building sweat equity.
Yeah, I think a lot of people have been sitting on the sidelines a bit, worried about getting in the market at quote unquote the wrong time, or not wanting to make the renovations because it's just going to be too much, they feel like. But I think it's worse to not get in and give it a shot, because it's the opportunity cost you're missing out on at that point.
That's right.
All right. Well, that's a good one. Any other good ones you want to share, or do you want to tackle the bad decision?
One, it's a little embarrassing, but it's me being real. It's truth. 2008, there was a housing crash. There was a major crash in the economy. It wasn't just housing. And I pulled out a 401k and I paid the taxes on it, and I used that money to live on.
And you paid the penalty.
I paid the penalties for it. And the massive penalty was not letting it sit for the next 20 years, because that was a large chunk of money that would be very valuable today and very valuable at my retirement. Now, I've learned a valuable lesson, and I've started reinvesting. And I know you and I've talked about IRAs and a few other, avenues we can look at. But that's my biggest regret is, thinking I could let's just take this retirement account and spend it now versus just sitting on it, leaving it alone.
Was your mindset that you were going to replenish it within the next year or two?
Correct.
Okay.
And I think that's what a lot of people did.
I hear it all the time, even now, when clients will call me about taking withdrawal from their account. And of course, I am your advisor. I am not here to place handcuffs on you and tell you to never spend your money. I don't even know I don't need to know what you're spending it on. Most people feel obligated to tell me, but they don't have to. And I hear all the time, I'm going to take this withdrawal, or I'm going to take this loan against my 401k or IRA, but I'm going to pay it back within a couple years or however long. 9 times out of 10, they don't pay it back. And then you lost all of those years of earning potential and compounding interest. And life happens, but it's so common. And it can cost you in the future. So understand that. And, I appreciate your honesty there. Now, do you have any advice for anyone that is maybe looking to buy their first home or wondering about purchasing investment real estate on what their first step should be or what information they should start putting together before meeting with someone like you?
Yeah, for the first-time home buyer, it's simple, just getting pre-qualified like we talked about, getting the first step out of the way, and then getting introduced to a phenomenal realtor. The real estate agent makes such a big difference in this market when it comes to negotiating, getting closing costs, getting things paid for, especially in that first home. A great home inspector. You want to have all these things at your fingertips because you get into a house and if the water heater isn't caught and the air conditioning's kind of running old, you want to make sure that you're getting in this house and not going to have those overhead expenses. So that's the advice for the first-time home buyer. For the investor, it comes down to what are your goals? What are you trying to achieve with real estate? And again, having a conversation with a mortgage broker, getting introduced to a great realtor that understands investing and the power of real estate. It comes down to just having those conversations.
Any other advice that you'd like to share today or some trends that you're seeing that you think people can relate to or want some information on?
I'm seeing bridge loans come back very, very strong. So a lot of people ask, what's a bridge loan?
I don't even know what that is.
It's when you take equity from a house. So for example, client wants to buy a property. They've got money in investments, 401k, IRA. They don't want to touch that crypto. They don't want to touch any of that. But they want to buy this house and they want to buy it now. Well, a lot of times to get your best interest rate, you want to put 20 or 25% down. And also it looks stronger on paper if you're putting that money down. So a bridge loan allows you to take, if you have equity in your current house, take that money and borrow it on an interest-only term and put it towards the new house for your down payment, not using your cash, not using your investments. And it allows you to purchase, close, and then say, okay, let's get this house cleaned up. Let's get it rented or let's get this house sold. And I can stage it. I don't have to worry about disrupting my family life. My dog's barking every time someone comes to the door. And it allows you to just take that money and move it to the next property. And then, like I said, once you sell that property, you pay off the bridge loan.
Okay, so that's when someone wants to move into their next house before they sold their existing house.
Yep.
Okay, that's
or
interesting.
Investors. I have an investor that took out a $400,000 line of credit, bought 3 other properties. They did that almost 4 years ago, and now they have equity in the other 4 properties, and they're pulling out now with the market that's dipped a little bit to buy some more properties. So you can leverage the bank's money again, going back to what we started the conversation with, and not use your own funds or investment accounts to tap into. You're using the bank's money instead of your own.
Very clever. There's so many strategies that we can get into about this, and I think it's fascinating, and I think anyone that is somewhat involved in real estate or wants to be will really find a lot of these tips helpful. And we're just scratching the surface. Of course, it's a personal type of conversation that you have to have with everyone. And I get that. So we're the same way. We can't just make blanket recommendations.
Right.
But now, Jason, there's been a lot of buzz right now in Florida about the Hometown Heroes program. Can you share a little bit about what that is? What kind of assistance that gives buyers?
So Florida is a great state when it comes to helping first-time home buyers. We've got a lot of different programs. We have USDA, bond, county assistance, but Hometown Heroes is specifically for heroes. So if you're a school teacher, if you're a first responder, paramedic, military reserves, there's different options called Hometown Heroes where you can get up to $35,000 or 5% of your sales price towards down payment or closing costs. The state funds it. So it can help someone where if the seller's paying the closing costs and the buyer could put $20,000, $25,000 towards the balance, get a lower payment to help qualify for a new home in the state of Florida.
Wow, that's great. And is that different than first-time home buyer assistance?
It is, because this is a bond program, so it's through the state, so you're getting the assistance. So there's a few more qualifications, meaning you have to work for a Florida-based company. You can't work for a company out of California or Nebraska to qualify. You have to work for a brick-and-mortar business here in Florida, and you have to be in one of those professions. There are income qualifications. There's a lot we look at, just like most first-time homebuyer programs, but this one is very beneficial to the right home buyer, and it's something worth having a conversation about if you know someone or have a family member that could be looking to buy their first home, taking advantage of this, because once the money's gone, it's gone, and only rolls out a couple times a year.
Wow, okay. That's good to know. And that's great that there are these programs that help our hero professions get into their dream home, because sometimes it can feel unfeasible, especially with where real estate prices are right now. And so if someone has questions on if they qualify for that Hometown Heroes, would you be able to qualify them?
Absolutely.
Okay. And same goes for first-time home buyer assistance in Florida?
Any type of assistance, down payments, I would love to help them have a conversation about it.
Okay, that's great. I appreciate that. How can someone get in touch with you if they want to talk about the pre-approval process or maybe taking out a HELOC on their existing property?
They can always call me at 813-781-2744 or just Google Jason Johnson Sunpoint Home Loans.
Okay.
And the first thing will pop up is our 5-star reviews. We're over 400 5-star reviews now.
Wow. And there's no charge for any kind of consultation?
Consultations are always free.
Okay. That's really good to know. Well, thank you so much for sharing some of the power of leverage, Jason. You're always a pleasure to work with and a wealth of knowledge. And for anyone listening, if you have any other questions for Jason that you'd like to funnel through me, or you need to talk about your finances, maybe you did do a refinance and you have a couple extra $100 a month that you can invest towards your future, we can maybe put it in a tax-free Roth IRA. Or you bought a home and you need some life insurance. Let's have that conversation. You can go to union-financial.com and click schedule a meeting. It'll take you to my calendar where we can book either a phone call, Zoom call, in-person meeting, always complimentary. And for everyone else listening, we look forward to seeing you on the next episode of The Future of Finance. I'm your host, Marissa Wood. We look forward to helping you live a better financial future. Thank you, Jason.
Thank you.
Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.